Rumors have been circulating on Twitter that UBS is on the verge of collapsing. Approximately 6 months ago, UBS acquired Credit Suisse, a move that was intended to stabilize the global financial system. This acquisition saw UBS agreeing to purchase Credit Suisse for a staggering $3.2 billion. Although there is some uncertainty surrounding the authenticity of a letter that has been circulating and garnering millions of views, the CEO of UBS recently spoke about the potential collapse of the bank. This raises questions about what information is reliable and what should be taken into consideration. One point of concern is the significant number of employees quietly laid off in the banking sector in America throughout 2023. In total, approximately 20,000 individuals lost their jobs, highlighting a trend of large banks discreetly reducing their workforce. Notably, banks such as Signature Bank, First Republic, Credit Suisse, and PacWest have made significant cuts in transactions, such as the acquisition of PacWest by Banc of California during the same year. This string of events prompts one to question the stability of the banking system and whether its claims of robustness are accurate. Janet Allen, a notable figure, has emphasized the need for increased protections to prevent bank runs, and Switzerland has echoed this sentiment, expressing their intention to implement consumer safeguards to safeguard against potential collapses of the banking system. As we move forward, uncertainties loom, and it feels as though we are steadily heading towards a climax. The worst may still be yet to come, and thus it becomes crucial to understand the situation more comprehensively. In this video, I will provide you with a thorough analysis of the events unfolding, allowing you to gain a clearer understanding of the situation at hand. Moving on to a recent development, Sergio Armonti, the head of UBS, stated that the bank holds a prominent position in the Swiss financial center and is considered one of the safest global institutions. He expressed this view during a Swiss Risk Association event attended by Reuters. Armonti further mentioned that in the unlikely event of a crisis, UBS has sufficient resources to withstand the impact before any resolution measures are considered. He reassured that taxpayers are unlikely to bear the burden of any losses incurred. However, if a situation arises where assistance is required, Armonti prefers a private buyer as a solution, which could potentially involve international buyers, according to Reuters. This statement is likely to generate controversy domestically, given past discussions about the possibility of selling UBS to foreign buyers during previous government rescues of Strand and Credit Suisse. It is worth noting the emergence of digital bank runs, a phenomenon instigated by the rapid spread of information through social media. Janet Yellen has discussed the issues faced by banks such as Signature Bank and Silicon Valley Bank in the United States due to these digital bank runs. This highlights the need for regulations and changes in accessing individual funds. Switzerland is currently addressing similar concerns with a general overhaul of its banking regulations, particularly after the failures of Silicon Valley Bank, Signature Bank, and Credit Suisse. Financial regulators worldwide have been exploring ways to prevent uncontrolled bank runs. It was only a matter of time before Swiss authorities engaged with relevant institutions to implement new regulatory measures and reduce the risk of significant deposit withdrawals. According to the article published by Reuters, ongoing talks between Swiss authorities and major banks, including UBS, are part of a comprehensive review of bank runs in the country. These discussions primarily focus on wealthy clients of Swiss banks due to their specialization in wealth management and the higher concentration of deposits they hold compared to commercial banks. Although negotiations are still in the early stages, sources suggest that measures being considered include the option of a staggered withdrawal of deposits. A significant number of customers have been withdrawing their deposits over an extended period, leading to considerations of imposing fees on certain withdrawal amounts. However, on the other hand, there is a possibility of offering a high interest rate as an incentive for customers to keep their savings for a longer duration. A representative from the Finance Ministry stated that the issue of mass deposit withdrawals is being analyzed within the broader context of the regulatory framework for banks that are considered too big to fail in Switzerland. The government plans to release a report on the outcome of these discussions in the spring of next year. Now let's delve into the specifics. UBS came up in this explanation. Although it was not mentioned during the search, there have been reports about new measures in Switzerland to prevent bank runs. This appears to be related to the situation at UBS. One may question why UBS would require a bailout when it is 3 times the size of Credit Suisse. with total assets amounting to $1 trillion, compared to Credit Suisse's $550 billion. The information presented here, including a letter circulating on the internet, suggests there may be some liquidity challenges at UBS. In this letter, which may or may not be authentic, UBS apologizes for the delay in processing deposit withdrawal requests, citing these liquidity challenges. They express understanding for the financial urgency and assure customers that they are actively working to resolve the issue as quickly as possible. They also emphasize their commitment to finding a satisfactory resolution for any customer inquiries or assistance needed. Observing the broader picture, one should contemplate the state of the banking industry in America. As of March, bank losses stood at a staggering $1.7 trillion in unrealized losses. This raises the question of how severe the situation truly is. Just 2 weeks ago, on November 9th, Bank of America, Chase, and U.S. Bank experienced system outages, preventing people from accessing their direct deposits. Additionally, major banks have been discreetly cutting their workforce, with Citibank announcing a significant reduction of 10%, resulting in the loss of 24,000 jobs out of their 240,000 staff members. Considering these circumstances, it is crucial to explore how banks can sustain their operations. One way is by utilizing depositors' funds to provide loans. However, the recent events and uncertainties surrounding major banks prompt us to question the stability of the current banking system. Banks, such as UBS, play a vital role in lending money to individuals and businesses for various purposes, including purchasing cars, houses, and running businesses. However, when a significant number of these loans turn sour, banks face a shortage of funds to lend, resulting in major problems. In 2021, UBS had a surplus of savings amounting to $2.1 trillion. This surplus enabled them to lend out massive amounts of money, making it relatively easy for people to secure loans. However, as of June, UBS's excess savings have dwindled to $190 billion. This means that in the span of 26 months since August 2021, they have been burning through $80 billion per month, leaving them in a precarious financial position. This financial predicament becomes concerning, especially with the upcoming holiday season and the significant impact student loans have on the economy. With the average monthly student loan payment amounting to $503 for around 43.5 million Americans, increasing problems are expected to arise. In fact, former Federal Reserve Chair Janet Yellen even expressed her concern in June, implying the possibility of more bank mergers as an attempt to alleviate the situation and assist the American people. While the authenticity of a recently surfaced letter from UBS remains uncertain, the timing of UBS making statements only adds to the concern. It is uncertain whether UBS is truly experiencing significant financial problems or if they plan to implement restrictions and changes to prevent bank runs and limit customers' access to their funds. Regardless of UBS's specific situation, one thing is certain: banks, in general, are likely to become more cautious and anxious about the loans they issue and the individuals they conduct business with. They will be more careful in their lending practices going forward, as they face the potential return of bad loans, leading to substantial losses. Moreover, banks rely on lending money into existence to sustain their operations. Without consumers who possess the necessary cash, creditworthiness, and ability to repay loans, banks will struggle to continue lending. In light of these circumstances, it is evident that changes are likely to occur in the banking industry. The precise outcomes and implications of these changes, however, remain uncertain. In the near future, the banking industry, both in America and internationally, is expected to witness a wave of consolidation. This looming event is anticipated to be one of the largest and most significant in history, affecting the financial and banking sectors. The impact will be swift, resembling a speeding train hurtling towards its destination. Numerous conversations are circulating concerning the magnitude of what is expected to unfold in 2024 and 2025, with many believing that it will surpass any previous crises, such as the 2008 economic meltdown, the dot-com bubble, and the real estate crash of the 1990s. This cumulative calamity is set to be packaged together, tied neatly with a bow, and presented to the American people. Consequently, significant problems are predicted to arise in 2024 and 2025. However, amidst these challenges, massive opportunities will also emerge. Individuals who possess intelligence, strategic thinking, and preparedness will be able to seize these advantageous prospects. It is crucial to have options at hand, as they will serve as a form of wealth in the era of this new normal. The key is to start having conversations about the options available and make informed decisions. As banks tighten their loan requirements, they will become increasingly cautious about extending credit. Therefore, it is crucial for individuals to take steps to position themselves favorably. Asking the question, if you were a bank, would you lend money to yourself, can be a helpful perspective. Focusing.